Right, good people. We are looking at complex groups. It's been a long time, but I guess now we are just going to be focusing on how to tackle the examination. Right, when we're looking at a complex group, it's more like a group of companies, a situation whereby an entity has got a subsidiary. It might be having an associate or joint venture, or a subsidiary having another subsidiary, which we call a sub-subsidiary. So basically it is just an issue, we can say it is just a group of companies. Right, so today what I want us to look at are vertical groups. When we look at the vertical groups, we are simply saying that a parent will be having a subsidiary, and a subsidiary will be having what we call a sub-subsidiary. Or we can have a parent with a subsidiary and a joint venture, parent, a subsidiary, and an associate. So these two, we are going to look at them when we are doing the topic for joint ventures and associates. So when we're looking at vertical groups, what we are looking at is the same thing with a horizontal group or a simple group, whereby we are taking the financial statements of the parent, we add the financial statement of the subsidiary, we add these financial statements of the sub-subsidiary. Then we eliminate the intra-group transactions. So basically that's what we are looking at. It is still consolidation. We are just taking the financial statements of the parent, the financial statements of the subsidiary, the financial statements of the sub-subsidiary, and also the journal entries are also the same, but the only difference now is that we have now taken quite a number of companies, and we are just consolidating quite a number of companies together. Right, so when we look at a vertical group, there is one thing that we need to take note of. Let's say there is a parent and a subsidiary and a sub-subsidiary. When do we start consolidating our financial statements? So this date that we start consolidating our financial statements is when the P Limited group is formed. Are we together? So when is P Limited group formed? P Limited group is formed when the parent acquires the subsidiary. Are we together? Now the contract between the subsidiary and the sub-subsidiary is something else when we are looking at consolidation, because when we are preparing the financial statements of the P Limited group, we are looking at a situation whereby when did P acquire S Limited? Are we together? So the group is formed when the parent acquires the subsidiary. So you might find out in the examination that there are actually different dates that are given. Are we together? So because there are different dates that are given, you will find out that you might get confused to say, now which date am I going to be starting to consolidate my financial statements? So what is important is you start consolidating your financial statements on the date at which the parent has acquired the subsidiary. Now let's look at an example. Let's say P Limited acquired S Limited on 1 January 2019, and S Limited acquired the subsidiary on 1 January 2018. So the challenge that we have now is that the dates at which this group of companies were actually formed is different. So when do we start consolidating our financial statements? Well, the most important part is the analysis. When we're doing a calculation for the analysis, the calculation of goodwill and the calculation of the non-controlling interest if the entity is applying the full goodwill method. So on the 1st of January 2019, that is when the group was formed. So therefore, when you are preparing the analysis of SS Limited, you are going to start on the 1st of January 2019. So you're not going to consider the 1st of January 2018. Yes, it's fine, you can consider it, but it will make your calculations more difficult. So the best thing is to start on the 1st of January 2019. That is the date at which the company was or the group was formed. So in this case, we say that the retained earnings that you are going to be taking for SS Limited when you're preparing the analysis for SS Limited will be as at 1st of January 2019. So I'm going to disregard 1 January 2018 and move to the 1st of January 2019. Right, please take note of that. So the group is formed when the parent acquires the subsidiary. So sometimes also you might find out, let's say that the dates are different. We are consolidating our financial statements. Then we see that the parent, the subsidiary acquired its sub-subsidiary on the first, let's say 31st of July 2019. Are we together? So when we are now starting to consolidate, we are still going to be using the 1st of January 2019. But one thing that we should take note of, on the 1st of January 2019, there was no sub-subsidiary. There was only a subsidiary. So what we are going to do is to consolidate. When you're preparing the analysis for SS Limited, it is going to start on the 1st of July 2019. Now, so please take note of that. Now, another thing that we need to take note of is that when we are going to be consolidating a vertical group, we start from the bottom going up. So we are going to start by preparing the analysis of SS Limited. That analysis for SS Limited is going to be transferred to the analysis of the subsidiary, that is S Limited. So you start from the bottom going up. So whatever profits that you are going to get from SS Limited are also going to be transferred in what? In S Limited. Why do we do that? It is because we want to see how many percent of the minority that we have in SS Limited. Remember, S Limited has got shares from the parent and shares from the non-controlling interest, and the non-controlling interest also have a share in SS Limited. So because of that, we need to start from SS Limited so that we need to see how much belongs to the shareholders of S Limited. Right, so for example, let's say here the parent has got 80%, the subsidiary has got what? 70% there. So we are saying that the 70% that is going to be shared to S Limited should also be shared, because P Limited does not have 100% of this, so they are supposed to share that 70% there. Are we together? So the profit for 70 is going to be shared 80% the parent, 20% it belongs to the non-controlling interest. So please take note, we start from the bottom going up. So let's look at question number 2 of your tutorial letter 102. I'm not going to write much on this question. Right, so let's look at the group structure of the entity. So they are saying the following trial balances of Bond Limited, Sydney Limited and York Limited are provided for the year ended 31 December 2017. So we have been given the share capital, we've been given the retained earnings, we've been given the revenue, we have other income, we've got long-term borrowings. So all those things are there. Then debits, we've got property, plant and equipment, investments in equity instruments, loan to York Limited, cost of sales, finance costs, other expenses, dividends paid, income tax expense, trade receivables and inventories. Right, so additional information which is going to help us to look at the structure of the group. So Bond Limited acquired control of Sydney. So we've got Bond Limited, he acquired control of Sydney. Right, what was the date? It was the 1st of July 2016, and they acquired 80% of the shares. Right, so if there is 80% of the shares, then number 2, Sydney acquired control of what? Of York. So we come and we put York there. Sydney acquired control of York. What was the date? It was the 1st of January 2017. So life is good here. We can see that here we can just start from there, since it is after the group was formed. Right, so on the acquisition date, the fair values of that, so we have to check the percentage. They bought 16,800 shares. We check how many shares does the group, does York Limited have. York has got 24,000, so it will be 16,800 divided by 24,000, which gives us how many percent? So it is going to be 16,800 divided by 24,000. It is going to give us 70%. So our group, we can see that the B Limited group, Bond has got 80%, Sydney has got 70% in York. Right, then we go to number 3, if there is any information there. Or number 3, they sold machinery, that's an intra-group transaction. As at 31 December, the directors decided that goodwill, it has to be impaired. So there was an impairment of goodwill. Bond Limited and Sydney Limited measure their investments in subsidiaries in their separate accounting records at cost price. So your investment is at cost. If it was at fair value, we were going to reverse any fair value adjustment that could have been made by the parent. Are we together? The SA normal tax is 28%, and capital gains tax is 80%. You may assume that both tax rates have remained unchanged since the 1st of July 2016. Right, then we move on. Each share price and vote are issued, and the issued share capital of all the entities in the group remained unchanged since the 1st of July 2016. So they want you to prepare the pro forma consolidation journal entries. So assuming that the entity is using the proportionate share. So if the entity is using the proportionate share, what it simply means that NCI does not have goodwill. Right, so they're saying prepare the pro forma consolidation journal entries of Bond Limited for the year ended 31 March, December 2017. So journal entries. Ziyabuya. Prepare the consolidated statement of profit or loss and other comprehensive income of the Bond Limited Group for the year ended 31 December 2017. Prepare the consolidated statement of changes in equity, and they want you also to prepare the statement of financial position. So I'm not going to write that much since we might be understanding what is happening. So what we do now, since they said prepare the journal entries, so I'm going to come and I write my credit and my debit there. Then I write these are journal entries. Right, so they want you to prepare the statement of profit or loss and other comprehensive income. So what is clear is we said you are going to add the parent plus subsidiary plus subsidiary. So in this case, we are going to be taking the figures and adding them together. Are we together? We are going to take the parent, the subsidiary, and the sub-subsidiary. We are consolidating. So basically, you write your structure of the statement of profit or loss, like how it is given there. Then you take your free marks. For example, revenue. When you look at your revenue there in the trial balance, it is 165, 124, and 148. So you're going to just go and add the revenue as it is there. You open your bracket, then you put the amount. Cost of sales, you do the same thing. You add the parent, the subsidiary, and the sub-subsidiary. Then we come to gross profit will be the balancing figure. Actually, it will be the profit, or it will be the total of revenue and cost of sales. Then other income, you are going to take the parent, subsidiary, and the sub-subsidiary. In this case, other income, there is only 24,000 and 63,000. That's what you are going to come and you put there, 24,063. The other adjustments, those are intra-group transactions. We are going to account for those. We look at the other expenses. You do the same: parent, subsidiary, and sub-subsidiary. Finance cost, parent, subsidiary, and sub-subsidiary. Profit before tax, you take for the parent, subsidiary, and the sub-subsidiary. So you are just adding. So life is good when it comes to the consolidation of subsidiary and the sub-subsidiary. Then other comprehensive income. So if there is no other comprehensive income for this question, then we've got total comprehensive income for the year. Total comprehensive income attributable to, we've got owners of parent and non-controlling interest. So as you can see here, there's 124,056. This we are going to find after we've made the adjustments. And take note, this is an amount that is coming from the total comprehensive income. And then the NCI, this will come from the analysis that we are going to be calculating. Right, so we have that information. Now let's go and to the statement of financial position. You do the same thing again. Statement of financial position, you have your assets, your non-current assets, which is PPE. Now PPE, then you have your goodwill, you have your deferred tax, non-current assets, you have your current assets, parent, subsidiary, and sub-subsidiary. Then trade receivables and inventories, you are just adding those companies in the group. Right, then we move on to, after we've taken our free marks, what we do now is we are going to look at the information and see if there are any marks that we are going to get. Right, so we are told the intra-group transactions that we are supposed to eliminate. So in this case now, on number 1, there was no intra-group. Number 2, we need to come and make an adjustment. The carrying amount is different from the fair value. So at acquisition date, all assets and liabilities should be at fair value. So they should be at fair value. So we need to make an adjustment and make sure that all those items are at fair value. Right, so what we do now is we are going to make an adjustment when we are preparing our analysis, or when we are preparing our journal entries. Right, so there is nothing on number 2. Let's go to number 3. When you look at number 3, Bond Limited sold machinery to Sydney on 1 July 2017 for 45,000. So it was sold for 45,000, right? And the sale was made at a cost plus 20%. So if it was at a cost plus 20%, what it simply means that we have our cost plus profit is going to give us the selling price. And they told you that the profit is 20% of what? Are we together? The 20%, they said it is on the cost. So it is, the cost is the one that is 100%, meaning that the selling price is going to be 120%. Are we together? So therefore, when we're looking at that 45,000, we are going to just simply say the profit element is 45,000 multiplied by 20 over 120, because the 45,000 is the price that the asset was actually sold for to the subsidiary. So let's look at the journals that we are supposed to be looking at there. So there will be depreciation that is going to be affected 20%. Bond is the parent, is sold to the subsidiary. So Sydney is the subsidiary. Therefore, it is a downstream transaction. It is not going to affect our analysis. The only time that the analysis of shareholders' equity is affected is when the parent is selling to the subsidiary. The only time that a transaction or an intra-group transaction affects the analysis is when the subsidiary is selling to the parent, or we can say it is an upstream transaction. Yes, so the upstream transaction is the one that affects the analysis, right? So let's not forget that. Right, so when we are to write our journal entries now, what we do is we have our debit and our credit like that. Journal entries. So the first journal, what we can see here is that the parent sold to the subsidiary. When the parent sold to the subsidiary, obviously when you sell PPE, it will be sold at a what? At a profit. So in this case, the parent has got other income, and the subsidiary is holding property, plant, and equipment. So if the parent is holding other income and the subsidiary is holding PPE, what it simply means is that we have to remove the unrealized profit. Why? Because the parent recognized profit on the sale of the asset. So what we do now is I'm going to come and reverse the other income and reverse the PPE. So I'll come and I debit other income, because other income has got a credit balance, so you're going to credit it. Then PPE is an asset, so to reverse it, you're going to come and credit property, plant, and equipment. So that I can say is my journal number 1. And how much is being credited? The selling price was what? Was 45,000. So I'll come and I debit my other income and property, plant, and equipment, which is 45,000 multiplied by 20 over 120. So 45,000 multiplied by 20 divided by 120 is going to give us 7,500. 7,500. Then we can see that there is a tax effect. And I always say, whenever you credit an asset, just know that your deferred tax is going to be debited. So you are going to debit your deferred tax and credit your income tax expense. So the question now that we are supposed to ask ourselves, are you using capital gains tax, or this asset is going to be recovered through use? Now when we are looking at this, they said the asset is being depreciated at what? 20%. So therefore it is allowed for taxation purposes. So we are going to come and we say 7,500 multiplied by 28%. So 7,500 times 0.28 is going to give us 2,100. 2,100. So that's general number 2. Now before we move on, they told you that depreciation is at 20% per annum. But now when the subsidiary was charging depreciation in his books, because he was showing the asset at how much there? 45,000. He was charging depreciation at 45,000. But we are saying that as a group, the value of that asset is not 45,000. Why? Because there was a profit that was made by the parent when they were transferring the asset to the subsidiary. So because of that, the cost of the asset is going to be 45,000 minus 7,500. So depreciation was supposed to be charged at 37,500, but it is being charged at what? At 45,000. So because of that, the consolidated financial statement depreciation should be reduced. And we know that depreciation is an expense that will be shown in other expenses. So we are going to come and we reverse that depreciation. All expenses have a debit balance, so to remove an expense you are going to credit. Then you come and remember the accumulated depreciation is the one that is affecting our property, plant and equipment. So basically, before we move to the writing or recognition of depreciation, you know, when you are recognizing depreciation, you debit depreciation and credit accumulated depreciation or the property, plant and equipment. So now what we are doing now on consolidation, since this was an intra-group transaction, we are saying we are supposed to debit property, plant and equipment or accumulated depreciation, the opposite basically, and credit our property, plant and equipment. So journal number 3, we are going to debit our accumulated depreciation, or I can say it is the property, plant and equipment. Then I credit my other expenses, assuming that this was acquired in the current year. Bond sold machinery to Sydney on 1 July 2017. We are preparing the financial statements for 2017. So it was in the current year. So meaning that we are going to put our other expenses. But if it was in the previous financial year, we were going to put retained earnings, because the profits for the previous year are included in retained earnings. So journal 1, right, so is done. Accumulated depreciation of PPE, so we're going to use 7,500 multiplied by 20% multiplied by when was it sold. It was sold on the 1st of July 2017. So it will be July, August, September, October, November, December, which gives us 6 months. So the 6 months depreciation that was being charged by the subsidiary was too much. So we are going to say 7,500 times 20% multiplied by 6/12. So 7,500 times 0.2 divided by 2 is going to give us 750. Right, so what is happening now? We are going to debit our income tax expense. and credit our deferred tax. Why? Because our asset has been debited, so deferred tax will be the opposite. 750 times 28%, so 750 times 0.28 is going to give us 210 and 210. Now we have created this journal, and please don't forget, we have created a template for profit or loss, template for statement of changes in equity, template for statement of financial position. Then we took all the free marks. The one that could be that could be blank is the statement of changes in equity. Why? Because we have to take the information from the calculations that we are actually making. So for now, other income in the profit and loss account, we are going to reduce our other income by 7,500. So if you check there on the statement of profit or loss, there is 7,500 rand that we have actually taken out altogether. Then in the statement of financial position, we are supposed to take 7,500 as our PPE. Then we come to journal number 2. Journal number 2 was the issue of tax. Deferred tax has been debited. So in the statement of financial position, you check where your deferred tax is. It could be under assets or liabilities depending on which one is greater. So in this case, there was an amount of 2,100, which is an asset, and an income tax expense of 2.1. So the first thing is you are going to reduce your income tax by 2,100, and then you come and you put under assets or under liabilities, which is a minus if you put it under liabilities there. So there is that 2,100 there, which is an asset in this case. Right, then we have accumulated depreciation of 750 and other expenses. So accumulated depreciation is going to be increased by 750, as you can see. And then other expenses in the profit and loss account are going to be reduced by the same amount, which is 750. Right, then we come income tax expense and deferred tax. So this time deferred tax is a liability. Income tax expense, if you check on your profit and loss account, there is that 210. Deferred tax in the statement of financial position, it is a minus. Why? Because it is a liability. Right, then we come to the next one, which is okay, we are done with our journals there, and this will not affect also the analysis because it was a downstream transaction. Right, then we move on to the next line item. Right, so at 31 December, the directors they decided, so goodwill impairment. So this one is important because the goodwill has been impaired. So what is the journal for impairment of goodwill? So you'll be having your debit and your credit, and the entity is using the partial goodwill method. So you are going to debit your impairment of goodwill, which is under other expenses. Then you credit your goodwill. We don't know if the entity has got goodwill, but that is a signal to show us that there is goodwill. So they said the goodwill was impaired by 6,000. So if it was impaired by 6,000, means that it was reduced by 6,000. So you go and you put your 6,000 goodwill, 6,000. So in the statement of financial position, where there is goodwill, you leave a space for the goodwill for the subsidiary and the goodwill in the sub-subsidiary. Then you come and you subtract the 6,000 under the goodwill. Right, then we move on to the next thing. Right, so after this now we are done with the free marks. Now what we want to do now is now to start preparing the statement of all our financial statements. We have taken all the free marks. Now we need to look at the calculation of goodwill and the value that we are going to take to the non-controlling interest. And remember, we said this is a vertical group. So if it is a vertical group, what it means is that we are going to start by analyzing York Limited, which is a subsidiary. So what we do is we are going to the next page. I prepare my analysis of shareholders' equity of York Limited. Right. So we have our total at, since a non-controlling interest, how many percent do they have in York? They have got 70. So going to come and put 100, 70, 70 and 30. Right, so we are done. Then we start with the share capital that was there. How much share capital was there in the books of York? So we are starting on number 2. So York Limited, they didn't tell us. So it was acquired on the 1st of January 2017. The retained earnings are not given on this question, but if you check on the trial balance, the trial balance is at 31 December 2017, but the retained earnings were at 1 January 2017. So it is given. So our retained earnings were 40,800. Are we together? So let me write there. This is at acquisition. Right, 40,800. Then you come to your retained earnings. How much were the retained earnings on that particular date? Okay. So from this information, our retained earnings at the beginning of the year is 40,800 for York. So I'll come and put my so I put a wrong figure there. So it will be 40,800. Then my share capital for York. Share capital for York is 24,000. So you put your 24,000. There was a revaluation of the assets at acquisition. Inventory was 25, now it is 20. So the inventory has gone down. So inventory will be 20, will be 25 minus 20. Which gives us 5,000. Then we have deferred tax, which is 5,000 times 28%. So 5,000 times 28% will give us 1,400. So this is going to be reducing your retained earnings. And then the next thing is trade receivables. They were 18, fair value is 18. So we come and we look at the trade receivables. 18 minus 8 will give us 10,000. Deferred tax is going to be 2,800. So when you add everything, it is going to give you the total there. Let's add. So you get 54,000. 54,000 multiplied by 70%, we are sharing, you get 37,800. NCI, 54,000 times 30% is going to give you 16,200. We jump a line, we write consideration and NCI. Our consideration, they told you that they paid 35,000. So come and check 35,000. Non-controlling interest, we check the policy of the entity. Are they valuing their non-controlling interest at fair value or at proportionate? So for this question, they said use the proportionate. So we are going to be using 16,200. So not goodwill for NCI. Here 37,800 minus 35. The consideration was less than the net asset, so therefore it is a gain on bargain purchase. Gain on bargain purchase. And please take note, the gain on bargain purchase is other income if it was acquired in the current year. Are we together? Like this organization, it was acquired in the current year, so therefore it is going to be included in other income. But if it was acquired in the previous years, you are going to put it or add it to retained earnings. So the difference here is going to be 2,800. So you get 2.8 there. Total will be 51,200. Right, so after that, we are going to look at since acquisition to beginning of year. Now, since acquisition to beginning of the year, what is important, there is no retained earnings. Why? Because this company was acquired on the 1st of January of the current year, so therefore we put nothing there. So we are going to remove since acquisition to beginning of the year, then we put only current year. So I'll put my current year. Right, the current year, we have to calculate the profit. Right, so how much profit are we going to make? So when you're calculating your profit, good people, you are going to look at the profit that was made by Yoko. So the profit, we are going to say there is revenue of 148,000. There is no other income. There we come and we take cost of sales. Is it 70,000? Then finance cost, we subtract. Other expenses, we subtract. We take out income tax expense of 14,208. Are we together? Right, so it will be 148, 70, 5,000, 22,000, and 14,280. How much total do we get? Right, so after getting that, what we do now, or what we need to be careful on, we have got this inventory and the trade receivables that we wrote down to fair value. So in the current year, we are going to realize them together. So please take note, whatever you subtracted under at acquisition, or what was reducing your retained earnings, you are going to what? You are going to realize it. So we are saying that our revenue was 148,000, cost of sales was 70, there was a finance cost of 5,000, there was other expenses of 22,000, there is tax of 14,280. Then we come and we add the inventory that was unrealized at acquisition. Now we are going to realize it, so it will be plus 5,000 minus its tax 1.4 plus 10,000 minus its tax of 2,800. Please don't forget, if you had written down anything at acquisition or written it up, you have to come and do the opposite of what you did here when you are going to be realizing it. So you are going to get a total of 47,520. And please take note, if there was any unrealized profit or any asset that was being transferred or that was sold to the asset to the parent together, or if it was an upstream transaction, that transaction should be adjusted. So for this question, there was none, so we come and write 33,264 and 14,256. Right, so that is the percentage there. Right, I will remove this for space. Right, and then we look at something else. There is the dividend. How much dividend was paid? Right, the dividends paid ordinary 9,000. So I'm going to come and subtract 9,000, multiplied by the percentage, 70 and 30, multiplied by 70%, you get 6.3 and 2.7. Then we get your totals, which are not necessary, but you can just do them to test if your totals are correct. 26,964 and 27,756. Right, remember the question wanted us to prepare journal entries. So if we are going to prepare our journal entries, what we do now is we are going to prepare the journal entry at acquisition, the acquisition journal. So I'm going to come and the elimination of owner's equity. So the first thing, this transaction, share capital has got a credit balance. So what we have done is that we have debited it. So I'll come and debit my share capital. How much am I debiting? 24,000. Right, retained earnings. Retained earnings, if you like, what you can do is to where is it? Yeah, so if you want, what you can do with the retained earnings, you can come and say 40,800 minus 5,000 plus 1.4 minus 10 plus 2.8. You put that amount in retained earnings. Or if you want, what you can do is to just simply debit retained earnings, credit inventory, debit deferred tax, credit trade receivables and debit deferred tax. Then when you are realizing it again, you are going to what? To make an adjustment. How it together? Come and debit your inventory, deferred tax, trade receivables, and deferred tax. So I'm going to prepare it the long way that I've done it. So my retained earnings is going to be 40,800. Another way that you can do it the same way. If you check on the solution how they've put it, the retained earnings, they have adjusted them. And I prefer to come and write that I have reduced my inventory. So I credit my inventory. How much is the inventory? 5,000. Then I'll come and debit deferred tax. Deferred tax, remember there are two. There's 2.8 and 1.4. So 2.8 plus 1.4, how much does that give us? 2.8 plus 1,400 is going to give us 4,200. So 2.8 plus 1.4 will give us 4,200. It's a debit, right? Then we are going to credit our trade receivables, 10,000. Are we together? Then we are going to reverse the investment that was made by the parent. So credit your investment in York. So the investment in York, it was acquired for 35,000. So we're going to credit that one. And then the balancing figure is the gain on bargain purchase. Gain on bargain purchase, which we should add to other income because it was done in the current year. So the balancing figure is on the credit side. So in the profit and loss, can you go and add in other income this gain on bargain purchase? There is no goodwill for this entity. So then this is called the elimination of owner's equity at acquisition. Then the next journal, since it was done in the current year, we need to come and realize the inventory and the trade receivables like I had mentioned. So the first one, we are going to debit inventory. How much is our inventory? It is 5,000. Check, we had credited it there. Now we are realizing it this side out together. So since this is inventory in the current year, we are going to come and credit the what? Cost of sales. How much is it? It's 5,000. You are going to reverse again your deferred tax out together. So you're going to debit your deferred tax to remove the deferred tax that was actually realized. Then we move on to the next one. We look at okay, let's debit our income tax expense 4,200, then credit our deferred tax 4.2. Right, we do the same for trade receivables. So we are going to debit our trade receivables, that 10,000, and credit. Which account do we credit for trade receivables? This we are going to put it under other expenses. Now we together. We have take note what we did initially. We realized it. We had reduced our our trade receivables. Now we are saying that our trade receivables have increased. The way I take it, I'm saying that I've recovered my trade receivables that I had written off. So if I'm recovering them, it means that they are increasing our profit. So therefore, I'm going to reduce other expenses 10,000. The tax effect, we are going to debit our income tax. Remember, if you reduce an expense, you have increased the profit. So I'm going to come and debit my income tax expense of we have done that one already. Remember, we did it as a combined figure there. Are we together? Right. Then we are done. Next, so we are done with this part. So we are done with this part up to there. Now, in the current year, we can see that there was a profit that was made of 14,256. We have to account for the profit that was made. So here we are going to debit NCI. Many people, they claim it like that, hang it. So it will be NCI in the profit and loss account, and then you credit your NCI in the statement of changes in equity. Right, please take note of that. The NCI. So it is the statement of profit or loss, and credit your NCI in the statement of changes in equity, or you can easily say it is the NCI in the statement of financial position. So I'm going to come there and say NCI, P&L, and SFP. How much is the value? It is 14,256. So 14,256, 14,256. Right. Next, from our analysis, I'm just taking the figures. There is the dividend. So when we look at the dividend, we are saying that the parent received a dividend, and the dividend was coming from the subsidiary. So therefore, we are going to debit other income because it was an intra-group transaction. So the dividend, the parent received 6.3. So I'm going to come and debit 6.3. Now, if you notice, our non-controlling interest has been reduced by 2,700 of that dividend. So I'm going to come and debit my non-controlling interest, which is 2.7. Then I credit my dividend paid, which is 9,000 in total. So what we have done here, good people, we've prepared the journal entries for the subsidiary. Remember, we said on our calculation, every time we have to calculate the first we prepare the analysis for the subsidiary, then we take it to the analysis of the subsidiary. So now what we need to do now is to create the analysis of the subsidiary, right, which is, what is the name of the subsidiary? The name of the subsidiary is Sydney Limited. Right, so we are going to prepare the analysis of Sydney Limited. Let me prepare it just below. Right, so it's the analysis of shareholders equity of Sydney Limited. Right. total at since non-controlling interest, it was 100%. How many percent did we buy from Sydney? 80%. So it's 80 and 20. So we're going to start with at acquisition. So at acquisition, we had share capital, retained earnings. When was our acquisition? It was 1 July 2016. Right, so with share capital and retained earnings on that particular date, the share capital was 48, retained earnings were 11,000. Right, 48 and 11. Everything was at what? At fair value. So you're going to just take it as is. Right, 48 plus 11 will give us 59,000. So 48 plus 11 to give us 59,000. Then 59, 47, 200. 20% is going to be 11,800. Jump a line, consideration and NCI. It was acquired for 65,000. So we come and we put our 65,000 there as our consideration. Non-controlling interest will be the same amount. Why? Because it is a proportionate value, which is the partial goodwill method. Right, then we move on. 65 minus 47,200 is going to give us 17,800, and this we call it goodwill. So in the statement of financial position, go and put goodwill of 17,800 now. So go and add 17,800 under your non-current assets in your statement of financial position. Then we come 17,800. The total will be 76,800. Then we come to since acquisition to beginning of year. Now, since acquisition to beginning of the year, what we focus on mostly is the retained earnings, mark-to-market reserve, revaluation surplus. Basically, I can say other components of equity. So there was no intra-group transaction where the subsidiary sold to the parent. So retained earnings at the beginning of the year are 68,300. But when we acquired this entity, the retained earnings were 11. So basically what we're looking at is the movement from 11,800 to the current retained earnings of 68,300. So I'm going to come and say retained earnings 68,300 minus 11,000. That is going to give us an amount of 57,300. Then you share 80% of that amount is going to be 45,840, and then 11,460. So what we have now, we have to generalize this amount to give the NCI its shape. If you want, you can prepare the journal entries as you are finishing a question, you go and generalize. But since we've got more time, I'm going to do it that after the analysis. Right, then we come to the current year. write the current year. First, I'll start with the profit. Now, there are going to be two profits that we have there, good people. Remember, this is a parent of York Limited. So meaning that the profits of York Limited are going to be transferred to Bond Limited, to Sydney rather. So in this case, the profit, this is the profit of Sydney. Then we also have the profit of York. Now the profit of York is not a challenge because we have already taken its share from the analysis there. The current year profit is 33,264. That's the amount that is for the shareholders of Sydney Limited. So it will be 33,264. So come and put my 33,264. 264. Now one would ask, why did we not take the full amount of 47,520? Remember, the other amount belongs to the non-controlling interest, and we've already given the non-controlling interest. It's 14,256 when we debited NCI and credited NCI. So we are only looking at the profits that are available to the ordinary shareholders of Sydney. So it will be 33,264. Then I come to Sydney. How much is the amount? Sydney, the profit, you do the same, 124,000. You come and you add other income of 6.3. You come and you subtract cost of sales 88, finance cost 20,000, other expenses are we together 2,000 minus 20 minus tax of 5,684. So that should give us a profit of 14,616. Right. Now, before we move, this profit of 14,616 includes a dividend that was paid by the subsidiary of 6,300. It was an intra-group transaction, so therefore I am going to come and I say subtract dividends from York. It's an intra-group transaction, 6.3, because I added other income of 6,300. So as you can see, the other income is 6,300, which was a dividend that was coming from its subsidiary. So that is the reason why I am going to come and take it out there. Right, so then we will be done. Right, then there is the issue of the gain on bargain purchase that was made in York Limited. That's another profit. This one, again on bargain purchase, 2,800. Remember, this 2,800, we don't own 100% of this of this organization, so we are going to come and we share it again. Gain on bargain purchase, 2,800. Some of it belongs to the non-controlling interest. So I'll put my 2.4 and 560. Right, then we will be done. Right, So let's start our journal entries. Right, which journal entries do we have? Now these ones are common, so I'm not going to waste time. You have them on your solution. They're not complicated. So the first thing, you debit your share capital, which is what we have there. You debit your retained earnings. Are we together? Then you're going to credit your non-controlling interest, 11.8, which is that. Are we together? And then we credit the investment, which is the consideration there of 65,000. This one we are going to credit. Then the balancing figure will be the goodwill, of which we already have it there as 17.8. Now the next journal will since acquisition to beginning of year. Remember the retained earnings, we added the parent, we added the subsidiary together. So what is left now is the recognition of how much profit are we going to give the non-controlling interest. So we are going to debit retained earnings and credit our non-controlling interest, which is that transaction there. So you debit the retained earnings to give the non-controlling interest its share. Remember, we had added the retained earnings of the parent, we added the retained earnings of the subsidiary. So now what we want to do is to just give the non-controlling interest its share. So we are going to give it 11,640. That's why you are debiting retained earnings and crediting your non-controlling interest. And then in the current year, there was a profit of, if you add this profit together, how much do we get? We will get, excluding that, we'll get a profit of 44,380. We share, then we share, we'll get 35,504, 8876. I hope you can follow. Right, so we are going to debit NCI. Are we together? So it will be NCI. So NCI in the profit or loss account and NCI in the statement of financial position. That is that 8876. Right, then there is the issue of the gain on bargain purchase. Remember, the gain on bargain purchase, we have already recognized it when we eliminating the shareholders equity. The gain on bargain purchase was recognized on the previous journal. There is it there, 2,800. Right, then the last item will be, we forgot the dividends paid there. I have to come and put my dividends paid. So dividends paid, they paid dividend of 5,000, 4,000 and 1,000. Or the 2.8 is included there. There's no separate journal for this one. Sorry. Right, it is included, so I don't have to come and share it. Right, so the dividend, the parent received 4,000. The NCI received 1,000 So let's come and create that journal. So you debit other income, debit non-controlling interest, and credit the dividend that has been paid. Right, so that's it, good people, for the journal entries. The intra-group transactions, those are the things that we are adjusting there on these journals. Then the next item is the preparation of the statement of changes in equity. Now, when we are preparing the statement of changes in equity, the first thing that we look at is the share capital. The share capital is the amount that belongs to the parent. So the share capital all the time, it is the parent. Please take note. So share capital, you just go and check on your trial balance. The share capital of the parent is 48,000. So that's what you are going to come and put as 48,000 altogether. Now, when it comes to retained earnings, the retained earnings, you are going to take the retained earnings of the parent, you take the share of the parent in the subsidiary, the retained earning of the subsidiary altogether. The sub-subsidiary, remember, it will be transferred to the parent, so everything will be in the analysis of the subsidiary. So when I look at the retained earnings of the parent, it is retained earnings, it will be 216,000. So it will be 216 plus the amount that is there on the analysis of the subsidiary. How much is in the analysis of the subsidiary? Retained earnings 45,840. So you go and add plus 45,840. That will give us that 261,840. And then total comprehensive income, profit for the year. You are going to take the profit that belongs to the parent. So in many cases, the profit for the year, what you do is when you've calculated your profit and loss account, where is our profit and loss account? Our profit and loss, the profit is 124. Let me remove all these things. The profit is 124,056. And out of this 124,056, 23,132 belongs to non-controlling interest. How did we get the 23,132? So the 23,132 belongs to the non-controlling interest. We are going to come and we say the NCI in the sub-subsidiary, it is 14,256. Are we together? And the NCI in the subsidiary is 8876. So that's what we have there. Are we together? So the non-controlling interest that we have is 14,256. That was taken from the sub-subsidiary. And what's happening here? 9173. We have got 8876. So I think they made a mistake. It's supposed to be 8876. Right. So that will be that amount there. So the amount that belongs to the owners of parent will be 124 minus 100, 2924. So this amount, in many cases, I call it the balancing figure. If you don't want your life to be complicated too much, so that amount will be the balancing figure. Right. So after getting the balancing figure, that's the amount that will go to the retained earnings. Then dividend. This is the dividend of the parent. how much did the parent pay as dividends paid. The parent paid dividends of 6,000. That's what you come and you put there altogether. Non-controlling interest, we look at the analysis again. How much do we have in our analysis? Right here, the non-controlling interest, it's 11,460. That's the beginning. This one was acquired in the current year, so you just take that 11,460 plus what was there when it was acquired. They acquired, how much was the value? 11,460 plus 11,800. Right, so 11,800, that will give us 23,260. The profit is what we have already calculated, which is 23,132. Another one that is important is the acquisition of subsidiary. Remember, we acquired the sub-subsidiary at the beginning of the year, and the amount in the analysis was 16,200. So you're going to come and you put acquisition of subsidiary, dividend paid 3,700. Where did they get the 3.7? There are two dividends that were paid to non-controlling interest. There is this 2,700 that is in the analysis of York. Then there is an analysis of Sydney of 1,000. So it will be 1,000 plus 2,700. That will give us that 3.7. Then you are done with your information there. So that's the vertical group. We'll do a more comprehensive vertical group when we are looking at when we are looking at the associate and joint ventures. That's what they like mostly. Thank you. So the next class will be the associate. So we'll be dealing with the associate in the next class. Siyabonga.